here's how you buy, here's how you sell, try not to lose all your money. That was essentially it. And, the failure rate was pretty quick, pretty robust. I watched what other people did. I kind of got a feeling for, hey, what's momentum? What's a trend? How do you get in and out? What's far enough? What's not? Because you start to learn very quickly, this works, this isn't working. What am I doing right? What am I doing wrong? And to me, the most fascinating part about prop trading was how inconsistent it was. You could have a fantastic month, one month, you could give it all back, and then some the next month, and then the following month, you could recover, so long as the losses didn't impact your psyche. Because there were some people, once they hit a bad patch, very, very difficult to get out of. The most intriguing thing was you're on a long desk, there's 10 people, all guys on either side. And I was always fascinated by, this week, this guy is killing it and this guy is getting killed. Next week it switches. Why? Why did suddenly doing the same thing? And that's kind of what led me down the rabbit hole of behavioral finance. The only thing that explained what was going on differently was how people were perceiving risk and opportunity, how they were acting, how good their view of the world was, how accurate it was, how willing were they to admit errors and get out of them. It's funny. I find venture capitalists and traders are really amongst the only people in our industry who very happily admit error, take the loss and move on. Most of the rest of our industry is loath to admit a mistake. And you can't not admit error as a trader, otherwise you're not a trader for very long. I really think of trading as a home run sort of game. I think of it as, just get some wood on the ball, lots of singles, the occasional, that sort of thing. Advance the runners. But every now and then you could either have a spectacular win or a spectacular loss. And a lot of that is just luck, ending up with right place, right time, and saying, let me try this, and then having the nerve to pyramid. Hey, this is working out. Let me add to this, and let me, on and on and on you go, until eventually, all right, I have to ring the bell. This is now too much money, and I don't care if it keeps going. A lot of that is right place, right time, a little bit of nerve, and a lot of serendipity and luck. But you have to recognize that. And the people who confuse luck for genius often end up regretting that. The two mistakes I used to watch regularly: selling too early and not selling soon enough. And let me put a little color on that.
That's like the basic conundrum of trading, right?
Right. So when something is working out, when it's going in your favor, and listen, never let a trade become an investment, and never let an investment become a trade, obvious. But if something is working out and you don't, for reasons of money lines or whatever, don't have to unload that position right away, and all the reasons that you basically lined up that trade in the first place, people just, they see a half a point, at least back in the day, that was 90s, those sort of swings were regular. Right. And sometimes you have to say, hey, this is working out. I'm going to let it keep working out. The flip side of that is you should be much quicker to take a loss. You should be much quicker to say, hey, I everything was perfect. Something in my analysis was wrong. Either I'm late or the analysis is wrong and this isn't working out. Rather than hope and wish and pray for it to get better, take the hit, save the capital, move on, live to fight another day. The Gerald Lowe book, The Battle for Investment Survival, as a trader, it is a battle for survival. Right. Because if you're engaging in that sort of hopeful trading, hope and wishful thinking, it's not a recipe for success. Let me add something. And it was only through the research and the reading about behavioral finance that I recognized that I was looking for the vein, and I love the dopamine hit more so than I loved my P&L. And so I very reluctantly came to the conclusion hey, if it's like a poker player who plays every hand,
Right.
hey, you have really shitty cards. Why don't you fold?
Right.
Because I love the action. I've heard guys say that. So
Right.
you're going to give up all your money. You
Right.
can't only play the best hands, because every time you play, people will know, and you can fold every time. But if you play every time the cards are dealt, you're going to end up burning through your capital. And so the decision to, gee, I have to be a whole lot more selective. I have to pull the needle out of my arm. I have to say, this isn't about the adrenaline, dopamine, neurotransmitter rush. It has to be about making money. Kind of led me to the conclusion. I'll tell you a quick funny story. Tuesday nights, we used to take the quote server when everybody was done. We would save our P&Ls onto the 3.5 floppies, literally walk them into the head trader's office.
Right.
Someone called that sneaker net. You would walk it in.
Right.
And Tuesday nights, we would turn the quote server into a Quake server. And, it was one of the first multiplayer network games where you could run around and grab a nail gun and frag your buddies, and it was a blast. And I noticed that the high of those multiplayer games was very similar to the high of trading. And that was kind of an uh-oh moment. It was like, oh, wait, so is this about making money, or is this about the buzz of having fun while you're trading? Trading is a lot of fun as long as you're not getting crushed. Trading is a blast. It's absolutely adrenaline-filled rush of excitement. And if you're doing it for the rush, then it's not a career, it's a hobby.
Correct. There are a lot of people, including many people in my room, who are doing it for a hobby. And I think it's as good a hobby as golf or anything else, because it engages your mind, it engages your passion, it engages your focus. But as long as you understand that it's a avocation, not a vocation, because making it a full vocation it's making it into a job. It kind of actually loses a lot of its allure, because you have to do a job, which means you can't do the dopamine hits all the time.
Right. It's work, and you have to be very probabilistic, and you have to be very selective.
Right.
And it means when you're pulling the trigger, it's not because you're looking for that buzz.
Right.
It's because, hey, this is the best setup I've come up. My risk reward relationship seems to be good. I have a very asymmetrical potential outcome relative to how much capital I'm risking. I mean, that's hard work to do, and it's relentless every day.
You basically have all the glamour of an actuary. You turn something from fun into a personality.
What can I do to squeeze the joy and life out of this? But doing that makes it profitable, and when it's fun, it's fun.
Right.
And much less profitable. I really like picking stocks, and I really like the action of trading. It's like, all right, well, take X percent, 2, 3, 4, 5% of your liquid net worth and set up a trading account. And if it goes to zero, say, hey, aren't I lucky that I didn't lose my real money? And if it doubles and triples, say, well, thank goodness it was only a small amount, because if it was all my money, I would never have had the balls to ride it. I can't tell you how many people I watched ride crypto all the way up and then ride it back down, or go from 5,000 to 10,000. Hey, I just doubled my money, and then watch it go up 5x from there. Too early or too late. So I had a buddy whose company in 1996 in New York got bought by Yahoo. His end of 96. His stock in Yahoo doesn't vest until the end of 99. And the way I managed, and only 25% of it vested, or 30% of vested, and the rest of it would vest over the next 3 years. So I tried to explain to him the regret minimization framework, which is simply just project yourself forward, and it's a simple box: sell, don't sell, higher, lower, right? Very simple.
Right.
There's only a couple of outcomes. Either you sell the stock and it goes much higher, or you don't sell the stock and it goes much lower. Everything in between, it really doesn't matter. Those are the big extremes that would really be devastating. So let's say you take the 25 or 30% that vested today and you sell it, and this is real money. We're talking tens of millions of dollars.
Yes.
Lifestyle changing money, generational wealth. Your kids and grandkids will all go to college, grad school. They'll all own homes, that much wealth. If you sell it and it doubles, it triples, it goes 10x, how much regret do you have? And the answer is, well, not a whole lot, because I still have the remaining 75% or so. Great. Now flip that over. Let's say you don't sell it and the stock goes down. That would be devastating. I would have all this. And therefore, what do you have to do? You know what your decision is. You have to hit the bid with this first 25% of your equity. And if it goes up 10x, who cares? You end up with a couple of $100 million. By the way, I used to love asking this question. What's the difference between $1 billion and $2 billion?
What's the difference?
Not a fucking thing. There's no difference between a billion, right? There's nothing. But, David Lee Roth used to say, it allows you to pull up in a very large yacht right next to it. And he's only half joking, because money gives you freedom, it gives you flexibility, it gives you security, and it chases away all of the things all of the lack of money blues. So if all the headaches that not having enough money causes go away, what you're left with is a pretty 1% problem, is a pretty, first world problem. What do I do with my excess wealth? As opposed to the ego of, how do I get my 50 to 100? How do I get my 100 million to a billion? How do I get my billion to 2 billion? And, if it's just a matter of more, you're probably going to be disappointed. There's always going to be somebody who's got more money than you. And if you're using it as a measuring stick, you'll ultimately be unless you're that guy. I think Elon Musk just became number 2. Somebody just passed him.
I think the Indian guy, Indian gentleman.
Right. So if that was your goal, and I'm not suggesting it was his goal, but damn, now I'm second.
Right.
It's so meaningless. Who cares?
It is.
You have to learn to time travel. If, imagine you're scuba diving and all of a sudden a shark is on you, and you say to yourself, gee, I wish I had a bang stick. Well, at that point, that's the defensive sticks that kind of scare away sharks. They blow up, they do whatever. Or shark cage, or whatever it is you're wanting to protect yourself with. Now, you can't go back in time. You can't go that way. But what you can do when you're prepping for that dive is, hey, what might happen? What are the risks? What steps can I take now to make sure that I'm as statistically safe as possible in the future? You can't eliminate all risks, but at least you can plan for all contingencies. I was very surprised when I sat on a trading desk. The guy on my right was a former Army Ranger. The head trader was a former Marine jungle combat instructor. And both these guys were monsters. And I used to love going out drinking with them, because I could be the biggest wise ass in the bar and no one was going to mess with me. They would look at me and then they'd look at those two guys and
they were like, it's not worth it. Yeah.
This guy ain't worth the trouble. Yeah. But I used to ask them, what was it like when you were serving? Tell me some stories. And the Ranger told me these really interesting stories about how they would prep for a mission. So not only are you mapping out the mission, but they would do this whole visualization of, here's where we're going to be picked up by the chopper, and here's how long we'll be sitting, and here's what's going to happen when we land. And they do these 2 things every step of the way. What is your emotional state going to be when this happens? If you don't like flying, how are you going to feel about it? How are you going to, and then what can go wrong at every step along the way? And what is your plan B, plan C, plan D? So what happens? You land and your gun jams. What do you do? What happens if the helicopter has to drop you 3 miles outside of the target? What happens? What if? And when they do this when they talk about, we trained for this mission for a month, they're not just doing the same thing till it's muscle memory, although that's part of it. They're like, what happens if this goes wrong? What do you do here? What do you do? So whenever some debacle would happen on a mission, A, they have a plan B ready, but more important for anyone who's a trader, they also have thought about what their emotional state is going to be like. Because in life and death situations, you cannot be either paralyzed with fear or struck with indecision. You have to say, shit went south. What's my next step? What do I
Right.
do? And by having those rules in place, by thinking out what that emotional reaction is going to be like, you manage to take panic and fear and at least manage it.
Right.
That sort of indecisiveness, what do we do, doesn't come up because you're basically know what your plan B is. But I was impressed with not just the ABC plans, but projecting out what your emotional state is going to be.
Yeah. Oh, that's brilliant.
So it's not a shocker. It's not a surprise.
Right.
You can really deal with it well. And so what I jokingly refer to as time travel, the ability to project out to the future and say, what am I going to be feeling? What might go wrong? What are my options? How can I resolve it? How can I minimize the damage from a bad situation? Or when things are working out, how can I maximize this and push my gains? Really comes from special ops. And, I've never experienced any of that personally, but when you hear stories from someone who's been through it and it's so vivid, you're like, wow, these guys, they really train you on all options, not just physical and mechanical problems that go wrong, but managing your emotional state in the moment is really key. And what applies more to a trader than when something is going wrong to not panic, and when something is going right to not, start, I love the line, the football coaches tell when someone, does a dance in the end zone, hey, pretend you've been there before, because that means your emotions are under control and you're not just spiking the football and dancing. It's like, hey, it's not 4:00 yet. You've got lots of time to lose this game. Be business-like, be workman-like, get the job done, get ready for the next play.
Right. Like Joe Montana. Why the S&P outperforms everybody is actually behavioral. And I like your opinion on my thought pattern here. So the number one thing that everybody does wrong is you were saying, nobody cuts losses. We all have endowment effect. We have this incredible leverage because we're thinking, oh my God, if I take a loss here, I'm going to be down 20% in my position. And, it's going to be a big hole that I have to fill, so on and so forth, right? So it doesn't matter who you are. It's incredibly hard to take a big loss, right? However, the S&P will kick out a company, anytime they underperform. They couldn't care less. They're creating an index. They're not really managing money. They're not thinking about that. So naturally, their behavior is to cut the losers. And the other thing people have a hard time is sort of chasing high, because I'll buy it on the retrace. And so, but the S&P couldn't care less. They bought Apple when it was already like, they put the Apple into the index when it was already like 100 times off its base. And
look at Tesla.
Or Tesla, exactly, or stuff like that. And so the irony of the whole thing is actually, I think the index has a huge behavioral arbitrage against human beings because it doesn't care. It's an index. And that maybe is another reason why the S&P actually, or whatever, passive index you have, actually outperforms active. I was wondering what you think about that.
So there's an enormous behavioral component, and I think it's a little, there's a few more pieces to it. So first, if you're just buying a passive index and holding it for the long term, there's no tax consequences, there's no additional execution consequences, there's none of that drag. Second, you end up with a circumstance where you're not, hold on one sec, hold that thought.
Sure. No problem.
Income the cavalry.
Oh, there we go. I kept mine. I said, there we go. He's a good boy.
So I tried to keep the door closed to keep them quiet, but when they want to come in, they got to come in.
We're very dog friendly on this show. Yes.
So second, I hear you. So second, you're not timing, you're not jumping in and out. So you get the benefit of compounding that perhaps somebody who's more active, swinging in and out, isn't going to get. And then lastly, and I think this is the most significant behavioral component, and full credit to Larry Swedroe for saying this, because the first time he said it, I'm like, what? No, that doesn't make sense. That's crazy. But the more I thought about it, the more correct he was. And it was, all right, you're 40 years old and you're buying an index because you're going to retire for 65 when you're 65.
Right.
You don't have to read the Wall Street Journal. You don't have to watch CNBC or Bloomberg. Right. You don't have to get sucked into the maelstrom that is the daily din of background noise that serves one purpose. And that's to distract you from the long-term business of investing with daily noise. And all this daily noise is irrelevant. You know, not only here's the challenge. Here's why active is so compelling. Like Michael Jordan, most of us play basketball. Very few of us are going to play at the college level. Even fewer of us are going to make it to the pros. And very few of those people become pros who make it to the All-Star team or the Hall of Fame. So, and I wrote something, I don't know, about 10, 15 years ago, comparing traders with athletes. And I actually showed the breakdown of there's 800,000 high school students that play basketball on a league, on a team. There is something like, I think the number drops to like 18,000 college players, male and female, at the NCAA level. And then once you get to the pros, it's like 2,000 people, both pros and other leagues outside of the NBA. Right. And, you know, there's 15 people on an all-star team. And how many bodies do they add to the Hall of Fame each year? 2, 3. So from 800,000 to 2, you're not going to be Michael Jordan. The odds are very much against it. And you're also not Jim Simons or Steve Cohen. And people, you know, the lure of that is why people buy lottery tickets, why people trade, why people, you know, someone is going to end up outperforming. And in you know, most years it's 30, 40%, slightly outperform. Once you bring in fees, it's even fewer. But it's rarely the same people 3 years in a row. Yeah. And by the time you get to 10 years, it's 1 or 2%. And beyond that, it's even smaller. So the appeal is, how can I be Michael Jordan? Howard Marks has this really insightful observation. The people who are at the top of the performance tables each year are rarely there for more than a year in a row, because it's always because of the circumstances outside of them. Whatever happens, you have a short fund and suddenly the Fed is raising rates and the market is down. Or the sector, oh, you know, if you were an oil trader last year, you're crushing it. But the year before was terrible and next year's probably terrible. So what you end up is the people who are in the top decile frequently find themselves in the bottom decile, and they bounce back and forth when it goes in and out of fashion. The appeal of indexing, to paraphrase Howard Marks of Oak Tree Capital, is, you know, if you're in the middle, if you get what the market gives you, over time, you end up in the top decile long term, not because you're doing anything so great, but because you're never in that bottom 10%, and everybody else ends up there, or bottom half on a regular basis. If you're getting what the market's offering you, you're more or less fine. And eventually that becomes, you know, very, very strong performance over 15, 20 years. But it takes 20 years for people to, you know, end up in the top and bottom of the index. So you could tell we're recording this in September, except private equity, but, you know, that's marked to make believe. Yeah. At a certain point, they'll have real marks and they'll be down also. So you have to have the conversation in advance. You have to read the emergency papers while you're safe and sound and on the ground. And you have to say to clients, listen, whatever happened last year was we've had this conversation a jillion times. Hey, 2021 was aberrational. Not only was it 28% up for the S&P 500, the market was never less than 5% away from an all-time high. There was almost no volatility. It was the lowest volatility we've seen. So from day one, clients need to know the reason we own a diversified portfolio. It means two things. First, it means there's always going to be a part of your holdings that are underperforming. That is a feature, not a bug. If international is doing poorly, Typically, the U.S. and the international don't do well at the exact same time. There have been decades where the U.S. has outperformed. There's been decades where the overseas have outperformed. So that's why we do that, to give you a little bit of an offset. We hold less correlated asset classes, which means we have some real estate, and we have TIPS, inflation-adjusted bonds, and we have corporate bonds, and we have preferreds, and we have treasuries. So this year, a handful of those have done well. In a typical market sell-off, those all do well, while stocks get shellacked. So there's not a perfect hedge, but you want your portfolio to be robust enough to sustain a downturn and not force you to I know some people advocate 100% equity portfolio, or I love the 200% equity portfolio. These things become really,
otherwise known as a zero equity portfolio at a 50% decline.
Right. So exactly. And, the best portfolio isn't the top performing one. It's the one you can actually live with comfortably and not keep you up at night. And so if your choice is, this portfolio is going to get 30% a year, but the swings are wild and the drawdowns are 40, 50%. My friend Wes Gray of Alpha Architects talks about this portfolio that's a mix of small cap and momentum. And he said, even God couldn't hold on to this. The drawdowns would be, if God would get fired for running this portfolio, what chance do we hold? So a portfolio that over time has shown persistency and outperformance, but wild volatility, wild drawdowns, for the average person is just not going to be appropriate. It has to be, all right, so where are we today? The S&P is now 29, the Dow is now 29,550. It's 3686 on the S&P 500. All right, so we're off, 20% on the S&P, 30% on the NASDAQ. So we've given back a big chunk of last year's gains. But not all of them. And last year's gains, we average 8% a year as investors. If you're plus 21% in 2020 and plus 28% in 2022, regardless of what's going on with the Fed and all the macro stuff, mean reversion is eventually going to kick in. You're going to get to that 8% one way or another. And whether that means going sideways for a bunch of years or just giving back a lot, what people forget about bull markets is, towards the end of a cycle, whether it's a cyclical 4-year bull market or a longer 15 to 20-year secular bull market, the end of that market always pulls forward gains from the next cycle. And the bear market is when you're just waiting for that wheel to turn and the next bull market to begin. So here we are watching this market go down. And, if you were unprepared for it, we didn't do a good job telling you about it. But the last word is Solomonic wisdom. This too shall pass.
And with that, I think we'll end it. We'll end it with there. We'll let you go because I know you have a hit of Bloomberg. I want to thank you so much. Barry Ritholtz is the founder of Ritholtz Wealth Management. You can find him there. You can find him on the Big Picture blog. Great follow on Twitter, as always. And a million thanks from everyone for your kind hour. I'll let you go. Thank you so much, Barry.
Thanks so much, Boris. Really appreciate it.